For the first time since March, the Bank of Canada has announced an interest rate cut.
Today, we lowered the policy interest rate by 25 basis points to 2.5%.
That's Bank of Canada Governor Tiff Macklem at his most recent news conference.
Considerable uncertainty remains, but with a weaker economy and less upside risk to inflation, Governing Council judged that a reduction in the policy rate was appropriate to better balance the risks going forward.
Here, as always, to unpack this latest decision is Scotiabank's chief economist, Jean-François Perrault. He'll tell us what this means for the state of the Canadian economy, the effect it might have on the housing market, the prospect of further cuts this year, and more. I'm Stephen Maurice, and this is Perspectives. JF, welcome back to the show. Always great to have you here.
Pleasure to be back.
So we're speaking around midday on Wednesday, September 17th, just a few hours after the Bank of Canada announced that it is cutting its key policy rate by 25 basis points to 2.5%. What does this tell us? What is your main takeaway from today's decision?
Well, it's an indication that the bank is a little bit more worried about the growth outlook than they indicated earlier this year. In fact, when the governor explained why they cut interest rates, one of the things that he pointed out was over the last couple of months, there's been a significant number of jobs lost, and that seemed to feature pretty prominently in their thinking. Because, of course, he's cutting interest rates in an environment where inflation, underlying measures of inflation, are in the 3% range. So it's not like inflation is at target, which is 2%. There's still elevated inflation, still some concerns on that front. But, this tug of war between weaker growth and higher inflation seems, for the moment, the Bank of Canada thinking growth is a little bit more of a concern. So they cut interest rates by 25 basis points to try and provide a little bit of support to the economy and help it get back on track.
What does it say more generally about the state of the economy? Are those signs that we're seeing, how troubling are they?
Well, it's a really mixed picture. Obviously, the sectors that are impacted by U.S. tariffs, so steels, auto, aluminum, Chinese tariffs on top of that, are having a hard time. There's no question about that. So you see high unemployment rates in some cities, lower unemployment rates in other cities that are less impacted. So there's clearly an impact that's being felt through the economy, concentrated in the trade-affected sectors, as we call them. And that's of concern enough at this point for the governor that he feels like maybe we can try to help him out a little bit.
So how much of an impact does a 25 basis point cut have on those factors that you're talking about?
Probably very little. I think it's Bank of Canada trying to help smooth the adjustment somehow. But, 25 basis points is peanuts, basically. If you're really worried about where things are going, if you're trying to balance risks to the outlook versus inflation, I think you need to do a little bit more than that. So we think after this meeting, there'll be another cut. Whether it's October, whether it's December remains to be seen. Maybe in December, once we've got the federal budget in November now that we know the date. But you need a little bit more than 25 basis points to truly start to impact how people behave and respond to that.
So does that mean there's a little bit of concern, but no red lights flashing yet, but maybe the bank wanted to send a signal about sort of the direction that it sees things going?
Yeah, I think so. And again, the governor was at pains, if you listen to his press conference, as we do, he was at pains to try and thread this needle of, listen, we're looking at maybe a little bit weaker growth than we thought, particularly on the export side, these trade-sensitive parts of the economy. But we're still somewhat concerned about inflation. So we're not out of the woods in terms of the inflation consequences. Tariffs are going to have an impact on Canada on inflation. Businesses are kind of rethinking supply chains, they're rethinking pricing policies, they're rethinking all kinds of things related to the evolving trade situation, and that will raise costs. And that is raising costs for businesses. So there's no question that there's an inflation impulse that needs to be managed, which I think seriously limits their ability to do much more than 50. Right. But that seems to be how he's thinking about it at the moment. I'll cut a little bit now, maybe rebalance the risks between inflation and growth somewhat, and then see where things go. I mean, the governor indicated, as he has for a number of meetings now, that they are more data dependent than usual. That is to say, their clarity on the way forward is much less than they'd like it to be. So they're going to go take some baby steps. Do a little bit now, maybe do a little bit later, see how things evolve, and if things evolve in the way that we all hope, which is that we don't get an inflation surge out of this, maybe they cut a little bit more. We're more concerned about the persistence of inflation. So we don't think they do more than 50 basis points. And in fact, we think maybe sometime next year they start to take those cuts back. But it is a uniquely data-dependent world because, of course, as we all know by now, President Trump's actions and how he engages with us and the rest of the world can have a very meaningful impact on a broad range of things that matter for Canadians and, of course, matter for the Bank of Canada.
Right. So very tough to make decisions with all of those different factors still in flux. When it comes to inflation, one of the potential or perhaps real drivers of inflation were Canada's counter-tariffs that it put in on the United States, which had the effect of raising some costs on certain things here. Those have largely been eliminated. So what is driving inflation now? I mean, it's been sort of stable. It's not going up. It's back more or less within their range at the upper end of it. What are the factors that are potentially keeping inflation higher than they would want it to be?
There's a little bit of questions about that. Obviously, food price inflation is still elevated. That might come down as we eliminate some of the retaliation. But it is a pretty broad-based increase in inflation. So when you look, for instance, at measures of inflation dispersion, so the number of components in the CPI basket that are rising by more than 3 or 4%, that's in kind of the 30% range, which is not low. So it suggests that there is kind of a breadth to what we're seeing on the inflation side right now. It's a function of inflation expectations. People expect inflation because of the tariffs. It's a function of costs rising for businesses generally. It's a function of wage increases, which have been substantial. It's a function of low productivity growth, which have made it difficult for businesses to manage these types of shocks. And it's probably also a function of people going back to the pandemic and businesses going back to the pandemic and thinking through what happened then versus what we thought was going to happen, or certainly what central banks thought were going to happen, which was this was all going to be temporary. So you had a little bit of pricing behavior that probably accounts for that. So it's a pretty broad range of things that are going on. But there's no question that removing the retaliatory tariffs will take a little bit of the edge off inflation. Not now, maybe next month or a couple months from now, 3-4 months from now. That does provide the Bank of Canada a bit more flexibility. We wrote some notes on that earlier this year, and the governor indicated that today as well, that one of the reasons, in addition to the employment situation, that he feels a little more comfortable cutting is the fact that these tariffs have come off, this retaliation has come off. So it's impactful at the margin. But the reality is, I think we're still not fully understanding what's going on in the inflation situation. I mean, the reality, taking a step back, if you think of it bigger picture, we've had weak growth since the beginning of the year, basically. That weak growth normally puts downward pressure on inflation, with a bit of a lag, but normally puts downward pressure on inflation. And we've seen a pickup in inflation for much of the year. Even before the tariffs came in, we had to pick up in inflation. So there's something going on the inflation front that suggests it's a little bit more persistent, a little bit more tricky to understand than certainly central banks would be comfortable with. And you've seen that time and time again.
And what is the bank's and what is your expectation around growth, which, as you said, has been pretty soft this year? I think even some shrinkage in the last quarter.
Yeah.
What are you seeing for the next year, again, given all the uncertainties around the economy?
So you got to make some assumptions about the uncertainty. So as we see things now, we're thinking growth in the low 1% range for Canada this year, 1.2, 1.3, something like that. It's not a recession, but that is not strong growth. We do expect an acceleration next year, though. So going from 1.2 to something like 1.5, 1.6 next year, because fiscal policy will start to take effect. I mean, we know that Prime Minister Carney and the provinces are thinking very seriously about how to help the economy transform itself, how to build. Mm-hmm. We expect to see some outlays next year that will be directionally positive in that sense. So the increase in growth that we anticipate largely comes from an expectation that fiscal policy will help out a bit more next year. So it's not a reflection necessarily of a kind of a super strong economy that the private sector is roaring to go and you're getting a turnaround. Because even 1.5, 1.6 is low by historical standards. Yeah. But it is an improvement. And that's occurring in the background of a U.S. economy which is reasonably weak, a little bit stronger than ours this year, but there's mounting evidence in the U.S. that, say, the non-AI sides of the U.S. economy are struggling. And we expect that to kind of go into 2026 as well. So we actually expect slower growth next year in the U.S. relative to this year and strong growth in Canada next year relative to this year. So a bit of an inversion.
Okay. You talked about fiscal policy. It was just announced this week that the federal government will be presenting its budget on November 4th. What is your expectation around the impact of what I think people expect is going to be pretty substantial spending, both on the economy more broadly, but then potentially on inflation as well, if there's an injection of money from the federal government into the economy?
I mean, it's a good question. Going back to the pandemic again, you might recall that going into the pandemic, there were very substantial support programs run by the federal government, the provinces, and other governments around the world, of course, very loose monetary policy at the same time, thinking that the impacts of the pandemic were going to be long-lasting, thinking that the impacts on inflation would be transitory.
Right.
So you had these very significant increases in fiscal deficits around the world, including Canada. And it turns out that that was probably excessive. Like, we know that now. Inflation became much more persistent than we thought, in large part because fiscal policy was just priming the economy nonstop.
Right.
So there is a clear link between what happens on the fiscal side to what happens on the economic side, what happens on the inflation side. So with inflation close to 3, underlying measures of inflation close to 3, which is kind of directionally where inflation is expected to go with, that's why we look at those measures, there isn't a whole lot of room on the fiscal side to turn around and say, okay, we're going to increase the deficit a lot to try and help us manage the shock without creating too much inflation. So It's a delicate balancing act they're going to have to play. One way to play that, and I think they've been talking about this, is to focus on investments. So focused on spending measures that increase the economic capacity of the country, the economic potential of the country, as opposed to transfers to individuals or businesses or things that provide a bit of a sugar high and create inflation without necessarily transforming the economy. And the federal leaders and the provincial leaders have been very clear. Like, it's, Build Canada, it's transformation, it's generational opportunity. They've got all kinds of words for it, clearly indicating that they will be focused on investment in whatever everything else in the budget. So that suggests a bit of an impetus to growth next year, not a whole lot, because anything on the investment side from a government perspective, of course, takes a super long time. Not like you can, decide you're going to build a military base up north now and have that done middle of next year. Right. It's not like you can build a bridge in a couple of months. It's not like you can, add to port capacity in a meaningful way. It's not like you can build transmissions lines in the space of a year. Right. So we expect some down payments on that and some early progress, but a focus on things that really increase, ultimately, hopefully, private investment via some public support.
Right. So what you're saying is, from perhaps an inflationary point of view, there are different impacts from just sort of spreading money far and wide to households, to all kinds of businesses, just to help them get through a difficult patch, versus targeting money at specific projects or infrastructure or industries which perhaps don't have that kind of, at least not the same kind of inflationary impact.
Exactly. You provide a bit of support with the economy in the short run through initial investments in infrastructure, but you capitalize on that by ensuring that what you're doing in the short run and you add to over the next couple of years really benefits the economy from a longer run perspective, not just a short run perspective.
Okay. Talked a little bit about the potential impact, which you said is probably fairly minimal, of a 25 basis point cut in interest rates. What other impacts are there in terms of households, individuals, businesses? Some people will feel that. Certainly people renewing a mortgage, that kind of thing.
I mean, that's where it's most likely to be felt, right? People that are borrowing, and particularly mortgage borrowers. We've seen impressive sales performance on the resale side in the last several months. And then the governor pointed to that when he was speaking today, that the impact of lower rates last year, because you'll recall, as we finally slayed the inflation dragon last year, that allowed the central bank to cut interest rates significantly. It takes a while for those rates to feed through the economy. And we saw some of that being fed through the economy in the late second half last year, even early this year. As uncertainty abated, as we got clarity on the tariff situation in Canada, which is much more narrow than we had feared, you saw that uncertainty wane a little bit, and those rate-sensitive parts of the economy start to pick up again, particularly on the housing side. So we'd expect that to continue, that as the central bank cuts rates, even if it's just 25 basis points, that encourages those rate-sensitive parts of the economy, which already seem to be benefiting from last year's cuts. So that's where we'd expect to see the majority of the impact. On the housing side, maybe on auto sales, much more on that side of the economy than on the business side of the economy, because sure, borrowing costs are a little bit lower because of this, if they borrow at the very, very short end of the curve. But businesses are also burdened by, not knowing what's going to happen with trade policy and the range of things associated with that. So don't really see much happening on the business side because of the cut. Focus on the household side.
And is there a risk of, housing, super complicated issue, lots of different factors involved, but if we make it slightly easier for consumers to buy a house with slightly lower interest rates, does that potentially contribute to inflation as well? Will it drive housing prices up?
So there's a very narrow window there. So either growth weakens more than you think, in which case you get a bit more padding, or inflation is otherwise weaker than you think because some other things are going on that you had internalized. But based on where we are now, that's the big risk. That's why we think there's only a couple of cuts at the most that they can afford to do without triggering some inflationary consequences that are tricky to deal with. Again, going back to the pandemic, if you misdiagnose inflation, if you cut too much, you keep rates too low, you create this inflation surge that becomes very challenging, both from an affordability perspective, home prices and a broad range of price of goods and services, that then requires significantly higher interest rates to break. And we saw that, right? Rates went well over 5 to try and bring inflation down. And it was painful for a lot of people.
Yeah. So you just mentioned there again, your expectation is for probably one more cut this year, either in October or December, I guess. And then heading into next year, you made some slightly frightening noise about them potentially having to take those back.
So it's an unusual forecast. We have them cutting one more time, wait a few months, and then start to take those interest rate cuts back. The way to think about it is there is this concept of the neutral rate of interest. The neutral rate of interest is the rate of interest at which the Bank of Canada policy rate is not impacting the economy in any meaningful way. So you're not pushing upwards on growth, you're not slowing growth down. There's a range around that, and the midpoint of that range is 275. And it's estimated, it's not empirical. It's empirical in nature, but you'll never actually know what the range is, and you never actually know what that neutral rate is. But it's broadly thought to be 275, or at least the way that Bank of Canada thinks about it is 275. So we've got a couple of cuts that would bring us down to 225. A reversal of that sometime next year that brings us back to the midpoint of what we consider to be neutral range, just to put the economy back on a neutral setting.
Okay, last question. What are the main takeaways Canadians should have from today's Bank of Canada announcement?
Well, I think the first one is we don't think it's one and done. So this first cut is probably going to lead to second cut later this year. Not much more than that afterwards, but some interest rate relief is going to be affecting households and businesses over the next few months, and that's a good thing. The second is it's very clear that the governor is still worried about this balance between growth and inflation, and that he's not convinced that inflation has been completely vanquished. So that's why we think only another cut and not many more cuts, because we still worry that inflation is going to be an issue, and he's going to be thoughtful about that. So those are two pretty important messages. A little bit lower rate cuts, but don't anticipate dramatically lower interest rates because they're still got to worry about inflation.
JF, thank you so much for coming in. Always appreciate it.
Thanks, Stephen.
I've been speaking with Jean-François Perrault. He is the chief economist at Scotiabank. Perspectives podcast is made by me, Stephen Maurice, as well as Armina Lagaya and our producer, Andrew Norton. The clip you heard in the intro was from the Bank of Canada. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.